I'm Ron DeLegge with ETF Guide TV. Enough with the small talk, let's get right to it. Let's take a look at stock market mood, and here's a barometer. As you can see, we're in greedy territory, and of course, greed leads to risk-taking, greater risk-taking, overconfidence, the illusion of skill, and lots of other crazy things. And we did move a little bit towards the less greedy side of the equation. We were in extremely greedy territory the past couple of weeks, but the point here is that if you are not investing with an adequate margin of safety, as I've warned you to do many times before, and I will continue to say that, you are cruising for a bruising. More on that in a second. Let's go to the next chart, which illustrates kind of my same point, but in a different way. Here's another way to examine the stock market's mood. This is a one-year performance chart of SPY, which tracks the S&P 500. That's the ETF. And then the VIX index, which is a gauge of stock market volatility and fear, primarily the S&P 500. And as you'll see with this chart, I like it because it shows part of 2022, which is extremely fearful. You'll notice the VIX was way up there. You can see it in late 2022. And then fast forward to now, 2023, you'll see VIX has dropped dramatically, and we've seen a rise in stock prices, SPY up, and VIX has gone down, meaning that there's a low level of fear. And the relationship, in case you're wondering, between SPY and VIX is pretty much an inverse relationship. So when stocks are up, usually VIX is down and vice versa. It's not always that way. You'll have really super weird time periods where that may not necessarily be true, where VIX has actually gone up and stock prices have gone up. There's been brief moments in history when that's happened. But for the most part, I'd say probably 85% of the time you're going to see an inverse relationship between VIX and the U.S. stock market, primarily, again, S&P 500. So this, again, is just another way to look at the stock market's mood when there's a low VIX like we have right now. That means fear is low. We did see a little bit of a pop this past week, but again, overall, if we look at it from a year-to-date basis, and this is through the market close of August 4th, 2023, we see the VIX is still down. Now, let's talk about the margin of safety framework that I've given all of our viewers on this channel. It's what I teach in my online classes, which are available to members of ETF Guide. It's free to get a membership, but you can't get access to the courses unless you're a free member. So I encourage you to take that step, become a free member, then you can have access to the courses. But this is what I teach, a 3-bucket framework. And I did a video earlier this week on this, got all kinds of opinions. I love it when I have content that really solicits some hot feelings one way or the other. I think most of you agree, though, that it's prudent to have your assets protected. We do that, by the way, with our physical assets, our cars, our homes. We even do it with our lives. So why wouldn't we do it with our capital? Why wouldn't we do it with our investments? I mean, it's common sense, people. And yet, the vast majority of investors are investing without an adequate margin of safety or any margin of safety. So here's the framework, the bucket margin of safety. You can see that right at the top. That's where you start. That's the beginning. That is the cushion. And by the way, this is one of the easiest, smartest ways to control risk. It's not that complicated. And you can go to etfguide.com again for help with this. Calculating your margin of safety, implementing your margin of safety, and then monitoring your margin of safety. It's more than just, go with CDs or go with T-bills or go with this or go with that. See, before you start even talking about what instruments you should be using to deploy in your portfolio's margin of safety, you first have to calculate how big your cushion should be. This is why I designed the tool. Go there and use it. Let's take a look at S&P 500 industry sectors. You've got 11 groups. 9 out of 11 are up. And the big 3, the ones that have been leading all year long, communication services, XLC, consumer discretionary, XLY, and then technology, XLK, up big with gains of 33% all the way up to 40%. Did I ever tell you that story, that incredible story about the investor who flipped a $12 million stock market gain into negative $4 million balance? But wait, that's not all. That same investor flipped that negative $4 million balance, that black hole, into a multi-billion-dollar fortune. Who is it, and what did they invest in? Well, to find out, you'll have to read it in my 5-star reader-rated book, Habits of the Investing Greats. It's available at Amazon.com. I've got a link below. And put it on your summer reading list. P.S. This particular investor is still alive and doing quite well. The other big news in the ETF market was the fee cuts on 11 SPDR ETFs. This was pretty significant. Around $77 billion in combined assets are in these 11 ETFs, and the SPDR portfolio suite now has lower cost than Schwab and Vanguard. I don't know about you, but when I see heavyweight champs duking it out, BlackRock, Vanguard, and State Street Global, and Schwab, they're duking it out. They're fighting to have the lowest costs in the marketplace, and when that happens, when fees get cut, investors win. And right now, ETF investors are winning. And here's just kind of an example of what that means. When we say 1 basis point, that's 0.01% or 1/100th of 1%. And so in this case, you'll see the first one highlighted there in red went from 3 basis points to 2 basis points. What that means, just for example, if you had $1 million in SPLG, the annual cost to the ETF investor would be $200 a year. Man, what a deal to get exposure to the S&P 500 for such a low fee. That's what's going on right now in the ETF market. We cannot get away without talking about the cut, the reduction in the U.S. government's credit rating that happened this past week. And when a person has too much debt, not enough income, they continue to overspend, overborrow, what ends up happening is they get cut off. They get frozen. And the game ends, and eventually bankruptcy, if they don't fix themselves soon enough, will arrive. Well, for the U.S. government, this is the same financial game of too much debt, too much spending, and not enough income. This has been going on for a while. And this past week, Fitch Ratings lowered the U.S. government's credit score from a top rating of AAA to AA+. And as you can see here, this chart here is from our friends at the Peterson Foundation, which have been educating the investing public, actually the American public, about this massive problem. $32 trillion in national debt alone. And you can see that that's bigger. That's bigger than a lot of global economies, including Japan, the UK, Germany, just to name a few. Now, here's the other problem. And this is, forget about that $32 trillion in national debt for a second, because we need to talk about the much bigger problem. And this was highlighted by the Cato Institute, that pegged the government's liabilities tied to Medicare and Social Security to almost $80 trillion. Now, both programs face massive funding shortfalls because there's not enough income, not enough revenue to support the skyrocketing number of Medicare and Social Security beneficiaries. And so my point in raising all of this and bringing this into the picture from a retirement planning perspective, what this means for our generation, it's just so crucial because it's so different than previous generations, is that our generation of retirees is going to face dramatically higher tax rates. And of course, those are probably going to be some benefit cuts, but I want to focus not so much on the benefit cuts, but the higher tax rates and what you need to be doing right now to combat the threat of higher taxes. I created an entire video series all about this. We talk a lot about proper positioning from a tax perspective. My series Portfolio Makeover, which is right now is in season 1. I've got the link below. Watch some of those episodes and you'll learn more about properly positioning your assets from a tax perspective so as to avoid this tsunami of higher tax rates And I don't want to talk about the politics and who's right and who's wrong and who spends more and who doesn't spend more. That's a total distraction. And you're missing the point when you begin to get into these political discussions of who's at fault. Focus on how this is going to impact your financial bottom line. This chart, I think this was, I'm not sure if this was Cato, but this illustrates the other problem, the massive imbalances in workers who are putting into Medicare and putting into Social Security versus those who are taking out. Today, the workforce is now older than ever. And you'll see how baby boomers really have influenced the economic things that are happening here to Medicare and Social Security. You can see in chart number 1, this was going back to 1984. There were a lot of baby boomers in the workforce. Well, fast forward to now, there's less and less baby boomers, and the workforce is older. In 1984, people under 40 made up more than 60% of the workforce. Well, that's fallen to 45% today, and it's going to fall dramatically more in the future. And again, the point is it's creating these massive imbalances that are going to be insurmountable. You can't, we've reached a point of no return, folks. And so these are massive structural problems. And I want you to focus, again, not on the politics. I want you to focus on your financial bottom line. And you even agree with me. This was a poll that we took at ETF Guide TV on our community tab. I asked, do you think U.S. income tax rates are going to be higher or lower in your retirement? You answered correctly. I was shocked at you guys. You did a great job because you're exactly right. 85% of you that polled said, yeah, U.S. income tax rates are going to be higher. And that's the correct answer. I see so many investors out there and even financial advisors, and it's shocking to me that they would actually believe that they're going to be in a lower tax bracket in retirement. Now, again, that was true of previous generations because we were in an environment when tax rates were declining. But now, with these massive structural problems, we see the U.S. government losing its top credit rating, and the credit worthiness is falling. We're going to see other credit rating agencies follow Fitch, and they're going to come out with their own lowering of the credit rating of the U.S. government. And so all of this is going to create some massive structural problems. U.S. tax rates are going to go up dramatically, not by a little, but by a lot. And so the way to position yourself, the way to protect yourself is to get your money into the tax-free zone. And again, these are things that I teach in our online classes at etfguide.com. You become a free member. We'll help you prepare for not just your investment portfolio, but also the positioning of your retirement assets so that you can protect and grow your money. Protect your money, of course, from the threat of higher tax rates, but also from the threat of falling markets. And extend the life of your money deep into retirement. And if you want, leave some behind as a legacy to your heirs or whoever follows you. And so a couple key takeaways from today's discussion: S&P sectors are way more bullish than they are bearish. We only have two sectors down, and they're down marginally. And so, again, the bullish performance is clearly there. We see the greed and fear index still in greedy territory. And, of course, my weekly reminder to always invest with an adequate margin of safety. And then my other message to you is to keep moving money into the tax-free zone. Don't let a single year pass by when you're not moving money from your taxable and tax-deferred bucket into the tax-free zone. That can be via Roth IRA contributions, Roth 401k contributions. If you don't qualify or you don't have that available to you, you can also do Roth IRA conversions. And if you can't do that, well, there's other tools that you can use that mimic Roth. And again, the thing is, we want you to be prepared for what's coming. Have some forethought and do some planning. And that's it for today's episode. I hope you've enjoyed it. Now it's time for everybody to go outside, move that body, move that blood, enjoy the rest of the summer. And I'll be back at you later this week. Actually, this upcoming week, we'll have new episodes of Margin of Safety along with ETF Battles. So we'll see you next time. Thanks for watching. Don't forget to subscribe. Adios.